Okay, and we are good to go now. So, I had initially just planned on today's show just to talk about what you see there, the chart on your screen, from hedge fund Crescott Capital, my friend Tavi Costa on Twitter. I've interviewed him in the past. Very good hedge fund manager. Sends out a lot of great charts on Twitter. Really good follow. Great research. So initially, I was only going to talk about the Bank of Japan and the European Central Bank expanding their balance sheets in only the last 20 days, $470 billion. Insane in only 20 days. However, since today is Thursday, and that is the official Fed balance sheet update, I also took a look at the Fed's official balance sheet today, and shocker, we skyrocketed higher. So, we are definitely, this is adding more and more to the crisis window. Again, I think the stock market having all that volatility and the roller coaster in the Dow last week, yes, it was crazy with the record down days in 10 days down for the Dow. The Dow was going down enormously. Well, 4 days down 10%, excuse me. And then the rally on Monday, how the Dow went up 1,300 points, and now the volatility in the Dow, and how professional money managers, according to Dr. Ben Hunt from Epsilon Theory, are fading the rally. But I think the real important thing, and what has the G7 finance ministers, the treasury secretaries, what has the central bankers spooked the most, is all the stories I pieced together with financial detective work last week. The 4 or 5 stories I talked about on the show a couple days ago about the credit markets freezing. So you have the junk bond markets freezing. You have the regular credit markets freezing. You have institutions, professional investors, dumping junk bond ETFs, selling these things. And Lawrence McDonald, who is a very good follow, LAWRENCEMCDONALD at Convert Bond on Twitter. That's CONVERTBOND. He used to be a very successful vice president at Lehman Brothers. He was actually running the most profitable segment of Lehman Brothers, and he wrote a book about why Lehman Brothers failed, and he's been putting out for the last couple days very interesting charts about credit spreads, bearish credit divergence between high yield credit and the stock market, how the credit started to crack first. And then also, I think he just put out a tweet in the last couple hours about how the VIX curve is now the most inverted since Lehman Brothers failed. So definitely follow him on Twitter if you're on Twitter. He writes the Bear Traps Report. I think it's an expensive newsletter, but he puts a lot of good stuff on his Twitter chart work for free. I will try to get him on for an interview, but the credit market is cracking, and this is why we had the emergency meetings with the G7 finance ministers and with the central bankers, not because of the stock market, although the stock market is important. The main reason is the credit markets are cracking. Junk bond issuance, credit markets cracking, problems in that. And this reminds me again, as I talked about a couple days ago, about the November 2018 when General Electric got downgraded. And then it started a rout. So you had Danielle DiMartino Booth talks about this at length in all of her speeches and all for the last couple of years, and YouTube videos and interviews. It's an important thing for her, where things were already starting to crack, I think, in July 2018, but the final straw, the nail in the coffin, where almost everything crashed, and then there had to be emergency meetings with the plunge protection team, the Federal Reserve, all the alphabet soup of banking regulators, the Treasury Department, was General Electric getting their credit downgraded, because then other analysts started looking at the balance sheets and the credit ratings then of other large cap companies that were doing the same financial engineering games with share buybacks with debt that General Electric was doing. And the stock market, if you remember back then, almost dropped 20%. So we're not dropping 20% yet, but the problems are they appear to me to be in the bond market. Okay, so I did not mention the Fed's balance sheet exact numbers. I ran the exact numbers. So just in the last week, the Fed's official balance sheet is now up over $80 billion, $82.87 billion. Big spike. Okay, George Gammon, shout out to George if he's in the live chat. He told me he might be in here. He told me he'd promote it. It's fine. If he does, if he wants to promote it or not, it's cool. Georgia and I are friends. Hopefully we'll be able to get him on for an interview soon on the podcast. Anyway, though, the Fed's official balance sheet, I don't know if this is pricing in repo, but the dollar is, on the dollar index, is really, really weak for about a week now. So the dollar index was already pricing in the Fed rate cuts and the Fed's balance sheet expansion. And I think behind the scenes, my educated guess, when you start adding the pieces to the puzzle together, connecting the dots with all those different bond stories I shared a couple days ago on the live stream show, with how the global credit markets froze up, problems with junk bond issuance, how junk bond issuance had totally stopped, professional institutional investors were dumping their junk bond ETF positions. When you add all those things up, that the Fed was worried, and I think... Oh, also the other story was the European bond markets. So February was the worst credit issuance for European bond markets in a while. So when you add all those things up, I think the Fed has already started to open the spigots again for the currency swaps. And that means a lot more dollars are flooding things. So you have, just in the last month or so now, you have the ECB, European Central Bank, Bank of Japan, and now the Federal Reserve putting in over $500 billion. It's like 500, I don't have the exact numbers in front of me, but over $500 billion in extra balance sheet increases in just the last month. So I really do, if the credit markets are that bad, if the junk bond markets are that bad, if things are freezing up that bad, I think the currency swap spigot opened last week. And one more detail about the Fed's balance sheet increases. So, since the end of August 2019, when the Fed's balance sheet, when quantitative tightening, which is BS, it's really just balance sheet reduction. When quantitative tightening officially ended, it actually ended before they officially ended it, but it ended at, let's see here, the numbers. The official balance sheet got down to 3.759946 trillion officially. And now the Fed's balance sheet, the numbers that we just got out today, the Fed's official balance sheet since the end of August 2019 is up over $480 billion. And they're only supposed to have been doing $60 billion per month in not QE. So it's way more than that. And they were telling us that repo madness didn't count on the official balance sheet, that wouldn't be added. So they're buying other stuff. A lot more. So Sears. We're only 6 months since the end of August 2019. So that should only be, what, $60 billion a month? It's still way above what it should be if they were buying $60 billion a month in U.S. Treasuries or T-bills. And those T-bills, what, are only 6 month ones, so those are supposed to roll off too, and they're just rebuying them. So they're buying a lot more stuff than they claim. I already talked about the dollar plunging. I think it's a combination of factors. So you have the rate cuts. You have the balance sheet expansion. I'm sure there was hedge fund managers or people on Wall Street, maybe Ben Bernanke, since he's getting the consulting gigs to one of those larger hedge funds. I'm sure they traded on inside information. It happens all the time on Wall Street, that people were shorting the dollar because they knew the Fed's official balance sheet numbers were going to come out and they were going to be big. And then I think the currency swaps, which flood the markets with more dollars, have opened up again. That's an educated guess. We will have no proof of the currency swaps unless there is actually an independent Federal Reserve audit, or the Federal Reserve or U.S. Treasury actually issues a press release saying, to calm markets, the U.S. Treasury and Federal Reserve are allowing the currency swap lines to the European Central Bank to reopen, massive ones. Those are the only two ways we will know if the currency swap lines have actually opened. I doubt we get a whistleblower. But in hindsight, with the stock market, it looks like that Economist magazine cover predicting that some of these large cap technology companies would have $2 trillion market caps, and the Barron's magazine cover predicting that the Dow would easily be over 30,000. It looks like those might have marked the top. Those might have been the contrarian indicator. I spoke on Twitter with a family office money manager, and he was telling me that there's been distribution by institutional investors of large blocks of U.S. stocks now for 6 months, but that retail investors were the ones who were driving up shares like Apple and Tesla Motors. Albert says Peter Schiff versus Brent Johnson 2.0. Hey, Albert, the Federal Reserve wants neither of them to win. The Federal Reserve wants stagflate and tax and lie. They want a managed decline of the dollar. And they will change the rules. They will do all kinds of programs. They will do whatever they can to have neither scenario of what Peter Schiff or Brent Johnson wants. Actually, I don't know if either of them wants it. They're predicting. Rather, they're predicting. Oh, and just remembered this point too. I have the story up here. Forgot to talk about it. So Jim Bianco now is tracking the Fed Fund futures. The market is pricing in and predicting additional interest rate cuts. So one more, I think, in March, and maybe another in April. Alan says an independent audit. In your dreams, Alan, you don't seem to be aware that there was actually an independent audit, a partial one that Ron Paul got. So we did get one. There just has to be enough people contacting their congressmen, Republican and Democrats, to push for it. Bernie Sanders and John McCain actually agreed, for one thing, for an independent audit. A one-time partial independent audit, Ron Paul got it. So it is possible, but the people have to write letters, call, email their congressmen or congresswomen and senators, and they have to push for it. Republicans and Democrats, it has to be bipartisan. That's the only way we're going to get a partial audit again. And then Bloomberg got the Freedom of Information Act request, 30,000, I think, document dump. And then some academics went through it. Wall Street on Parade, Pam Martins, they wrote an article citing a college research paper on going through the Bloomberg FOIA request, Freedom of Information Act request, and they found out that it was actually 26 trillion, not 19 trillion, in covert backdoor bailouts that the Fed gave out in 2008. Silver Junkie asked, when will the dollar fall? The dollar is already falling for about a week now. The dollar index was above 99 from February 12th, I think, to February 25th. So it was above 99 for a while. And that was putting a lot of pressure on the global economy. And now the dollar index in only like the last 4 or 5 days is already below 97. And in my opinion, that is because the Fed is issuing more dollars because things are that dire. The People's Bank of China has done enormous repo spikes too. So you have credit markets globally freezing up. You have China putting out record repo too. The Fed is still doing repo. George Gammon, shout out again to George, does a fantastic job with his videos. $170 billion in repo, oversubscribed yesterday, I think. Okay, so I'm going to look at listener questions and comments, and I'm going to wrap up the show. I think I did. Oh, you also have... Oh, I wanted to talk about the dollar. So there's a... As I talked about for my Patreon account contributors, there's an audio podcast back there, and I try to explain the difference between regular risk-off and extreme risk-off. Extreme risk-off is what happened in 2008. Extreme risk-off is where gold crashed, dollar, even though a lot of people were holding physical gold, people's... who had margin calls, professional money managers may have been forced to sell their gold because they had margin calls on other investments because they were over leveraged. And gold stocks also sold off for a while. However, if you bought gold stocks in the bloodbath in 2008 and 9, if you bought them then and you started accumulating positions for cheap and you held some of them for 18 months, I made 400% to 600% on a good number of gold stocks. So this is why, this is a lesson why you do not buy. Smash the like button too. There's only 52 likes, please. This is why you do not buy for any, especially mining stocks, gold mining stocks, but stocks in general, you do not buy. The retail investor makes this mistake all the time. You do not buy all of your stock positions all at once. It is the most common mistake by far. The other common mistake is someone inherits a lot of money or has a lot of savings and they don't know anything about fundamental trading or technical analysis, and then they get into options trading and they think that they can make a quick score and make a lot of money and get rich, and then they end up losing all their money and hate the stock market. That's the other main common mistake, is people who don't have the knowledge base and the experience investing in trading markets get into options trading way too soon. I've heard that story all the time as well. So in an extreme risk-off scenario, normally the dollar would go up, U.S. Treasuries would rise in price, which means yields on Treasuries would go down, which is what's happening now. What you have, the 10-year U.S. Treasury, let me pull it up real quick. You have the 10-year U.S. I need some water. 10-year U.S. Treasury below 1%. It's a 0.9260. What that tells me is that professional money managers are moving into U.S. Treasuries. They are closing out, they're fading all stock rallies, they're unloading stock positions, and they are moving into Treasuries. And I think this has a lot to do with the credit markets, more than the stock market. So while there was a roller coaster in volatility in the Dow for the last 10 days or so, well, more than 10 days, last 2 weeks in the Dow, the credit markets cracked last week. I showed you on the live stream show a couple days ago 4 or 5 different stories. They're in the information and description section. Go and read them and piece them together. The credit markets cracked. And that's really, really bad. Okay, I got a super chat from Dimitri. He's in miners for 5 years. Very, very happy even after the sell-off. How would he know when risk-off switches to extreme risk-off? Should you keep miners at the time? In an extreme risk-off scenario, you would see the gold price rising, the paper price, gold price rising, and the miners would start to sell off rapidly. So you would know by the divergence. You would know by the divergence between the gold price going up and the mining shares continually going down. That would tell you with price action that professionally managed money are selling their mining shares while even though the gold price is rising. So if that continues, that would tell me, at least in my opinion, that this is extreme risk off. Now you have to be careful with the miners because some of these mining companies have bad balance sheets still. They are improving. Margins should be, for most miners, margins should be pretty good for Q1 2020. We have an oil price below $50 and we have a gold price above $1,600. Unless the mining company management is totally inept and there's a cerveza outbreak at one of the mines, the mining company should be making good margins now. Should. Now, in an extreme risk-off event, people don't want to, the professionally managed money people either have margin calls on other investments or trades and have to sell miners, or they don't want to hold miners. They just want gold exposure with physical gold or GLD or the Sprott Physical Gold Trust. So if this is just my opinion, if there was an extreme risk-off event and you had a really quality company like Franco-Nevada or Wheaton Precious Metals or Sandstorm Gold, if those shares sold off a lot, Sandstorm Gold dropped below $6 last week. It was a good buying opportunity. I think it got down to, $5.80 or something like that. It was a good buy. I didn't check the price today, but I think it's already rallied quite a bit. Yeah, it says $6.34 now. So it was at $5.80 at the end of last week in a sell-off, and it's already up to $6.34 again. This is a company that's adding more cash flow online. It's well managed. Franco-Nevada is the best, safest gold stock. So if Franco-Nevada dropped, that's something I would look at. But it rarely drops anymore. It does. I mean, it drops a little bit. I'm talking like a 10, 15, 20% correction. It rarely does that. In 2008, Franco dropped a lot, and that was a good buying opportunity. Silver Wheaton Go back and look at the chart for what happened to silver Wheaton from 2007 to 2009. There was an amazing buying opportunity for silver Wheaton, now Wheaton Precious Metals back then. I have a friend who loaded up like crazy on shares. He bought tens of thousands of silver Wheaton shares back then and made a fortune in a couple years. Okay, I have one more super chat from Chris Malloy. Is a leveraged ETF like Nugget, NUGT, or GDX a bad idea? So I don't like the leveraged ETFs, Chris. If you want leverage, first of all, you get leverage with the mining companies. So with oil prices at these prices and gold and silver, well, especially gold prices are doing better than silver prices. I don't look at silver prices today, but gold prices are doing better the last couple days than silver prices. Silver was below 17. Let me see where it is now. Okay, silver's above 17 again. Silver's at 17.43. I don't have Kitco up. This is on Yahoo Finance, but it's above 17. Gold prices on a relative basis are still doing better than silver, but the gold miners you get leverage with, if you want even more leverage, you may want to learn options trading. But that's very risky. If you screw up options trading, you can lose a lot of money very quickly. The leveraged ETFs are risky. I know someone that made like $10,000 in a week trading these leveraged gold mining ETFs, and then he didn't pay attention to it, and within like 3 or 4 months, he had lost all that money because he didn't pull it out, and then he had an enormous loss. So he lost all his paper gains, and then he ended up being in the hole too. Okay, another super chat from Dimitri. What about First Majestic Silver? Okay, I was going to do this for Patreon account contributors for an audio podcast, but I'll briefly talk about it. I think my honest assessment of First Majestic Silver is they are a mediocre silver mining company. The best and safest, lowest cost silver mining company is Pan American Silver. Pan American Silver almost never puts a mine on care and maintenance. They almost always expand the reserves at the mine. Lately, First Majestic Silver, they do own 2 good silver mines, but 2 of First Majestic Silver mines, other silver mines, are now in care and maintenance. So I think First Majestic Silver needs to probably go and do an acquisition and find a 3rd silver mine that is better than some of the silver mines they already own. It is not a good sign if when silver was above $18 an ounce, they had to still put two silver mines on care and maintenance. So First Majestic Silver owns 2 good silver mines in Santa Elena, which they bought from Silvercrest, and San Dimas, which they bought from, I'm drawing a blank right now, Primero, right before Primero went bankrupt, I think. So they bought those are their 2 best silver mines, and their other assets are not very good. And they just put 2 mines on care and maintenance when silver was above 18. Pan American Silver is the best, safest producing silver miner. And in March and April 2019, it was at $10 a share. It was really cheap. So while all these other silver pumpers were saying that there was all these better silver companies, the best one was on sale for $10 a share about a year ago. That was the bargain. One of the best bargains I've seen in a long time. Pan American Silver management, much better. They almost never put a mine on care and maintenance. They are really good at running costs, very good at maintaining margins. They're pretty good at bringing a mine on time and on budget. That's what you have to look at for a management team. It's when management teams put a bunch of mines on care and maintenance, even when metals prices are higher than they were, and bad acquisitions that are written down and other stuff, and the mine is not able to replace reserves. Those are red flags. So I think First Majestic Silver is good, not great. The honest assessment is they have some problems. That's fair and balanced, unlike Fox News. Okay, well, I'll take a look at listener questions and comments for another couple of minutes. I think that's about it. That's pretty much all the stuff I wanted to cover. Bottom line, though, the balance sheets for these central banks, it's coordinated. Okay, so when the European Central Bank, Bank of Japan balance sheets were starting to increase, the U.S. stock market was starting to rally again. But now we're in a crisis scenario where the central banks are trying to stop the credit markets from freezing up and wreaking havoc. The problem is the entire banking system and the derivatives market, everything's over-leveraged and way too many derivatives. And now you have counterparty risk. So you have repo spikes in China. Repo is still going on here in the US. It's a good question. Is silver still a precious metal? Yes, but silver also has an industrial component. And again, I've been the only person in the gold and silver community talking about this for years now. There is way too much silver byproduct. The copper miners do not care about it. The copper miners hedge it. The copper miners let the bullion bankers use it to manipulate the market. The copper miners, when they bring on a new copper mine, don't care about the silver as long as they can get some money for it. So either they hedge it or they sell it all to the banks. So we need that silver byproduct to come offline. So silver's industrial component is causing damage. Now maybe with the cerveza problem here, silver will be an actual cure. Maybe because China just ordered at least some units to spray for what is it, silver misting machines at $10,000 each to spray hospitals and operating rooms to disinfect them. Andy, it looks like helicopter money has already started just in the last month. And the Fed balance sheet spike is enormous because the Fed balance sheet had not done much for the last 8 weeks. It had been in a trading range for the most part. Okay, well, that's it for this live stream show. Thank you for hitting the like button. It's much appreciated. So I can get more people to the channel. My subscriber count's been stuck at 31,000 now for, I think, like 2 months. But thank you very much to my Patreon account contributors. It is growing unbelievably fast now. I'm amazed how quickly it's growing. People are signing up for $5 a month and trying out the content behind the paywall. There's a lot of audio podcasts, chart work, some written articles. I spent hours working on a new article for Disney that just came out in the last couple days, going through all these different details from analysts and talking with some of my contacts who are professional money managers, some of the stuff they were telling me. Over 400 Patreon account contributors now. Can you believe that? I added almost 200 in the last 4 or 5 weeks. I think it's just under 200 people added signing up in the last 5 or 6 weeks. Pretty crazy. If you work hard, you can turn your life around in 12 months. It's not easy, but you can do it. Okay, everyone, thanks for listening, and definitely check out some of the... Excuse me there, I just had a brain fart. Okay, thank you everyone for listening. Everyone have a great weekend. We'll see what happens. I don't know why the audio just cut out there. We'll see what happens. That's weird. We'll see what happens tomorrow. The stock market is in a really big volatility trap right now. The VIX popped. I forgot to mention that. One last thing, the VIX popped. Big pop from the VIX. Up over 20% today at 39.62. At some point, if the VIX keeps going up, we're going to have one of these VIX exchange-traded funds or VIX exchange-traded notes blow up too.